Good afternoon, everyone. Thank you for coming. And well, today I have a real treat for everybody who's here. I'm going to be telling you what I think it's what's hot and what's not for 2020. And given that we're in a resource investment conference, I think that we're going to have a lot of good news for people who are interested in resources. My name is Omar Ayales. I'm Chief Trading Strategist for Gold Charts for Us. We have a weekly letter. We analyze markets, and we analyze also investment opportunities on a weekly basis, based on technical analysis, fundamental analysis, and analysis of macro global trends. You know, I don't want to overkill the gold. Yesterday we had a conversation about gold exclusively, and basically the only thing I wanted to point out for those of you who couldn't make it yesterday was the relevance of gold breaking above 1365 last year. That resistance level, which basically gives a solid new floor for gold in its next secular up move. We were saying yesterday how if you're even a long-term investor in gold, how it's even a good price even right now at the frothy levels of 1560. We do believe that there's going to be a pullback before the continued rise, but I do feel that 1365 level is going to hold. We're telling everybody, we're telling our subscriber base to go ahead and, if you're a trader, wait for a dip to about 1400 to buy. That seems like a little low right now, but we do think for a variety of reasons, some of which are going to be correlated in this presentation, so you will be able to see. Another chart that basically tells me what's going on in the world are U.S. government bonds and U.S. interest rates. Of course, you all know probably they move. They're inverted. They're exactly inverted. The yield determines the price in the bonds. The bond play, the U.S. bond play, the long-term bonds in the U.S. have been one of the best investments in 2019. Were one of the best investments. I think most of the sideline cash that was probably rolled over into bonds were the biggest beneficiaries from that move, more than the bond trade itself. However, our studies show that this nearly 20-year uprise in bonds that has come off the tops it could be ripe for a continued rise. We believe that this also tells us that interest rates in general, which now this is a chart on the 10-year yield, that conditions for businesses are going to remain accommodative, meaning that is going to be in the U.S. and worldwide a situation that's going to be favoring business. This is broadly speaking. What does this also tell us? This also tells us that most likely that the safe haven trade that we've been seeing is going to be scaled back. How does that jive with bonds rising? Safe haven bonds are a safe haven. Well, we do believe that the bonds could soak up any safe haven trade that might still be left, but also just by artificially keeping interest rates low and still the U.S. bond market having to readjust to what's going on in the rest of the world will keep bond prices in the U.S. frothy. You know that until recently, just another comment on this interest rate move, you've seen, for example, the whole situation regarding the repurchase agreements, the repo market that is happening in the U.S., how many people have said it's not QE, well, especially from the Fed, everybody else basically saying it is a QE. Instead of this being something that has swayed investors away from the market, is actually giving investors support, telling them that ultimately the lender of last resort is here, and it will help grease the chains. It will help business moving forward. This Fed has proven to be very business oriented, especially of course with Donald Trump as president. Another thing that I'm seeing that is going to be shaping investments, and before we go into those specifically, is basically a weaker U.S. dollar in 2020 that I'm projecting. So you see the chart on the left is the dollar since 2011. You see that it's actually been rising since 2011 in a very actually ascent uptrend, showing that it's been very strong. However, the dollar peaked in 2017. It fell precipitously to 2018 lows, and then since then actually has been rising with gold, something that is not very typical for the US dollar. However, the chart on the right, you see that it's a little bit more short term since 2018 rise in the dollar, and is breaking below this pattern we call a rising wedge. technical analysis tells us that this pattern is actually a bearish pattern, and the dollar just broke below it. It confirmed it, and it's telling us that the main theme for 2020 is very likely to the downside. This in itself should be a catalyst for all sorts of asset classes across the board, particularly gold, of course, precious metals, resources, and U.S. stocks, and also global stocks, emerging markets as well. We feel that a lot of the money that has been sidelined into cash is actually going to be put to work in 2020. We can also see in this other chart that I have, these 4 charts. Okay, these 4 charts basically show different currencies. I've just selected these currencies because I really like the British pound. I do feel that it has actually confirmed, the Brexit low support of 2016. You can see the chart, the 2016 figure moved a little bit, but that first low of the British pound, which is the top left chart, actually shows how it bottomed in 2016. That was just at the Brexit referendum. It bounced back, and it actually went to test it at the height of the Brexit uncertainty. What was going to happen? And then whenever the election in the UK basically gave the parliament back to the Conservative Party in an overwhelming majority, we actually saw the British pound bottom at that level as well. I think that from now on, from moving forward, with not only Brexit behind us already, as even though it hasn't been signed, we have a parliament that in the UK that is ready to move forward on this, and not only that, not only move forward with Brexit, but also has the votes, the necessary votes to implement the economic agenda that is needed to see what happens moving forward. I see a very bright outlook for the British pound. You see the Canadian dollar on the right of that. And below that, the Singapore dollar. And the reason I mentioned both of these together is because look at their movement. Actually, it's very similar to what's been going on in gold and in resources. You see a 20-year rise that actually peaked around the 2011-12, and then it actually collapsed until 2015, 2016 lows. Those were also coincidentally the lows in gold or lows in resources. Since then, they've been basically rising. Now, they have been very timid in their rise. But we believe that this year, especially with dollar weakness, that we're going to see some of these other currencies be back in vogue. I mean, I don't know how many of you are Canadian here. I'm sure many, several, if not all. But how is it possible that we actually get to buy stuff in Canada at a discount from the U.S.? That's a little, from somebody who's outside of both of these countries, a little crazy. But that's one of the reasons why I think that the Canadian dollar is going to appreciate closer to the US dollar, or the US dollar is going to fall a little bit. I also show the Chinese yuan just because it is very representative of emerging markets. Okay, and we've seen that actually the rise since the 2018 lows, coincidentally also the gold lows, okay, the yuan has actually been rising stronger than most other currencies. I think that this is a theme that will remain in 2020. And then we go into the resources, okay? The reason why I show copper is not because I am necessarily gung-ho on copper. I see copper as a model. Dr. Copper is one of the resources that is used mostly in all sorts of activities regarding building, technology, different areas. And it has been called Dr. Copper just because it has a wide variety of demand from different places, like most of you know. So that is why I like to follow copper. Dr. Copper tells us pretty much where resources are going. And if you see this chart, which is from 2016, the 2016 lows, okay, mind you, copper has been rising. At first. It took off with great strength. And then from the peak in 2018, it has been falling. And just last year, just in 2019, we actually saw it break above this moving average. This moving average that we use is a 65-week moving average. All of the different moving averages that we've tested over the years, this has been the one that can actually grasp the entire moves best than any others that we've tried before. So you see, if you've actually just traded based on this 65 moving average, you would have stayed on that amazing rise since the 2016 lows, and you probably would have been out for the most part of the decline until now. One of the things that also, to see back in resources is look at crude oil. I mean, we've seen oil rise to about $62, $65 intraday with the whole Iran situation exploding, and then come back again to the mid to higher 50s. And it's easy to get lost in the day-to-day trading to see like these prices, 62, 57, 58, $60. But the reality is that if you look at this chart from 1970, we can actually see that crude oil has a really strong support right around the $40 range, which of course that's $15 less than what it is the price at right now, which obviously it's a lot. And if you're a trader, you never want to trade that downside unless you're short. But it does tell me that the downside is limited with a stronger upside potential. That 2008 downtrend is a key figure for me. It's right now at $65. If crude oil, and this is WTI, can actually break above this level, we could actually see it rise even to the 2008 highs eventually, but definitely my target is around the $80 if it breaks the 65. So I'm really closely watching this level. And very interestingly, look what moves together with copper. Copper is not only indicative of what is actually happening worldwide in resources, if we're going to be where they're heading to, where we're going, but actually this emerging market chart, which basically is an emerging market ETF that is highly traded. I index it to 100 with copper since the 2016 lows, and look at this. The similarities are just starking. So the movement between copper and emerging markets is basically tracked. And you see now that with copper breaking out, emerging markets following, we already saw those base bounce ups in the other currencies. This is telling me that 2020 could be a really good year for resources overall. Of course, individual resources you can pick together depending on what is your risk aversion. But in general, this is telling me that the up move in resources is going to probably be broad-based. Another chart that I like to use to show where is basically investor sentiment and trader sentiment. Where are we? Are we buying? Are we preferring risk assets? Are we preferring risk-off assets? What is it that we're going to be investing in and why? Okay, so obviously these are very hard questions that entail a lot of different analysis. But if we could summarize it into a couple of charts, this is one that I really like. This actually is the Dow Jones Industrials in the US versus the Dow Utilities. As many of you know, the utilities have been usually traded as safe havens. Okay, they are a safe haven trade because they're very stable companies. They don't really offer a lot of upside potential, but they have good dividends. They're very stable regardless of when you're actually operating this business. It always has a very stable income and operation, which is why it's considered a safe haven. The industrials, of course, are more growth, value and growth oriented. You see this chart from 2009 lows. It has been uptrending in favor of the industrials since then, until it peaked in 2018. Remember again, 2018, this coincided with the bottom in gold. Okay, so these two events are correlated. They're not independent in themselves. Okay, so in 2018, we actually saw the utilities, a safe haven, kind of same with gold, same with gold shares, same with risk off assets, safe havens, actually appreciate against risk on assets throughout 2018. This was their dynamic. Now, at this level, we're actually reaching to a low. And I'm not showing it here just because it was a little too much to explain in the time frame that we have. But right below this chart, I have a leading indicator that is actually at an extreme bottom, suggesting that downside is limited. So although we could still see the ratio bottom out at current levels, it is very likely that it's time for it to rise again in favor of the industrials. This is another chart telling me that risk on assets will be favored over risk-off assets, including gold, especially especially as it pertains to the first half of the year. I stole this chart from my presentation yesterday. Okay, and this chart basically tells me, similar to the one before, okay, but it's basically a ratio between precious metals and industrial metals. And this is a long-term chart, 20 years old. You see that for the past 20 years, industrial metals have outperformed precious metals. This basically tells us that the economy over the past 20 years globally has grown, okay, which is not a surprise to anybody. The key thing here is that you see that every time that the ratio rises to that big, thick blue line at the top, okay, for the past 20 years, it has consistently resisted at that level. And in the past 20 years, every time that that level has been reached, it has been a great buying opportunity for resources, okay? So you see the big spike up from basically 2018 lows, which again, going back, that was the low in gold. And we see it spike up to the top side of the down channel, okay? That was basically the up move in precious metals over the past year. We already see that probably that upside has been, at least for the foreseeable future, medium term, has been overextended. And it wouldn't be abnormal to now see resources outperform gold or precious metals for the next 6 months, maybe even a year. And risk-on sentiment is not only going to be fueled into resources. Of course it is. And I think resources are the space that actually offer the most upside potential. We're seeing that resources actually have such a big upside. And if you're really looking to double or triple your money over the next few years, resources is definitely going to be the space to be. However, even though, and although a lot of people are talking about, well, this is crazy, how can you be in US stocks? They've already made this huge run, it's been 10 years. You know, excuse after excuse after excuse. And yes, I share with everybody, and the people who have said this, I share with them their views. However, I am not exactly entirely convinced that this up move in the US stock market has actually finished. If you actually see this chart is a beauty. I'm comparing the past 3 bull markets, longest bull markets over 50 years, starting from the year 1 when they actually started and to the year 13, 14 when they ended. So you see the line in blue is the bull market that started in November 1974 and finished in August of 1987, right before that huge collapse. We have then the green line, the bull market that began in 1987, right after that big collapse, and then reached the January 2000 highs, and then the March 2009 bottom, which of course we all know what happened then, to today. If you actually see the chart, there is a slight gray line that is a vertical gray line that it actually touches the blue, the red, and the green line. That actually tells us where we are today when we compare to these other moves. So you have maybe been seeing and hearing some people talk about a melt-up rise. Now, some of them sound very optimistic, and I don't want to mislead you either, but you know, it wouldn't be surprising, and it shouldn't be a surprise, that actually stocks have another hurrah, not only based on this chart, but correlated with the others that we've been seeing. We've been seeing how resources are poised to outperform precious metals. We've been seeing how utilities, which are safe havens, are supposed to outperform the industrials. We're starting to see that 2020 is actually a play about risk and about, you know, business growth, about emerging markets, about where we're going with these things, and not about sideline cash or safe haven assets. What is going to cause this market collapse in the US? Well, I mean, my guess is as good as anybody else's, you know, but I do feel that over the past 2 years, okay, the whole trade dispute narrative that everybody says that it hinders trade, it's stopping the stock market from rising, this, that, and the other, the entire thing that you guys, I'm sure everybody here knows, okay? This chart basically tells us that all those concepts are not real. How so? The S&P 500 indexed to 100 with the Shanghai Stock Exchange since the trade tariff talk began early in 2018, right after those first Trump tweets and stuff. You see that since that level, even though they were kind of moving together at the beginning of the year, the S&P 500 outblew completely the Chinese stock market. The main loser in this trade war has been the Chinese stock market. What's going to happen when these tariffs get rolled back? You know, these tariffs have actually allowed, you know, Donald Trump to keep his super strong consumer buying American-made products and keep, you know, the U.S. stock market rising. I do believe that if a full trade truce is reached where tariffs are actually eliminated, this could actually be a sell-off event for the stock market. You guys heard me yesterday talk about silver. Silver is one of the best plays, I think, right now, is the best value trade. The resource trade, I think, is helping it. But in its relationship to gold is so extreme that it makes it a no-brainer.